Dobar dan. That means good day. This is TalkCast PDX on the web. You can find us at talkcastpdx.com. It's Tuesday, October 19th. Name of the show is the Bogdanich Perspective. I'm your host, Paul Bogdanich, and welcome. This is episode 33, and I titled episode 32 Waiting. And I was going to title this one Still Waiting. But when I got in here, I decided to change it to Wait Some More. And for us aged folks, that's an old joke. Cheech and Chong's next movie. The theme of the movie was Cheech and Chong are hanging around the house one morning, and Donna calls Cheech and says that she's going to come over later. So Cheech kicks Chong out of the house so that he can clean the house and, make it nice for Donna. And then he goes to pick up his cousin Red. But anyway, he keeps calling in during the day, and the guy's cleaning the house. And then around noon, he's cleaning the house, and he calls back at 5. Is Donna there? No, not yet. And, he calls back about 7. And he's got candles lit, and the place is all cleaned up, and he's all cleaned up and everything else. And he starts talking to Chong. He says, "Oh, this is starting to make me a little upset. I've been waiting all day. I cleaned the house. I've been doing this. I've been waiting. I'm starting to get mad." He says, I'm kind of at my end of my rope. You know what I'm going to do if she doesn't call, man?" He goes, "No, man, what are you going to do?" He goes, "I'm going to wait some more, man." But that is... is why I called it Wait Some More. I'm going to start again with the Creed. The Creed is something that I wrote. It's the details for why I think each element in the Creed are true are listed in the first, call it 7 episodes. They're only audio, available on TalkCast PDX. I say some things that interest rates can't rise above 2%. I did a whole episode on why that's the case, how stocks have disconnected. There's no calculable value anymore. I did about an episode and a half on why that's the case and all the rest of that stuff. But I condensed it into a creed, and I'm going to read the creed. And it goes like this. Looking at what's left of the bond market, lying in what's left of Wall Street, and wanting to earn more than 2% on our savings, we are functionally compelled to participate in the stock market. There simply is no other risk-free or low-risk alternative that pays more than 2%. Through our own fault, by assenting to the government spending as it was happening, as evidenced by our re-electing the same congresspersons and senators year after year, decade after decade, we have contributed to the situation where interest rates can't rise substantially above 2%. This has resulted in the loss of our low-risk investment alternative that we used to call the bond market. Artificially low interest rates also destroyed the former correlation that used to exist between stock prices and interest rates. This disconnects the value of a share of stock from any calculable underlying value, and the share of stock becomes worth whatever someone else is willing to pay. More buyers than sellers make stock prices go up, and more sellers than buyers make stock prices go down. We further acknowledge that the Federal Reserve has been acting as a buyer of last resort. This causes asset inflation, but prevents the stock market from suddenly correcting to some unreasonably low level. Whether we like it or not, agree with it or not, or are willing to admit it or not, if we want greater than a 2% return, we are functionally compelled to participate in the stock market and are therefore reliant on the Federal Reserve guarantee. In brief, my concern is just the asset markets are inflated. Everybody knows they're inflated. We're forced to participate. Is the government going to fess up essentially to what they did and manage the inflation so that we don't get harmed? That's essentially my question. What could force them to make adjustments? And for the last 2 weeks, I've been saying political ineptitude, inflation, supply chain disruptions, and COVID. I would clarify that and say inflation, supply chain disruptions, and COVID are your main external factors. The political ineptitude is kind of like this overarching thing that exacerbates all of them, causes, magnifies the intensity of the mistake and so on, and makes them larger threats than they need be. And that's, I would say that. One of the things that I've been talking about is Chairman Powell, chairman of the Federal Reserve Board, who's in charge of the asset inflation. His term runs out in February, and it's by this time they should have either renominated him or nominated somebody else. There's a number of Democratic senators, principally Democratic, that oppose his nomination, but they're in the minority. So they're doing their usual smear campaign to try and scuttle his nomination. This last week, these senators and their operatives, Robert Reich, former Secretary of Labor under Bill Clinton, people like that, are trying to push a story about how Chairman Powell sold all his stocks after the pandemic, used his position as the chairman of the Federal Reserve to recoup his assets when he sold his stocks. Simply not true. Justin, if you could put up graph number 1. This thing is just the chart that I've showed last couple of weeks. It's just the chart of the S&P with the 200-day, 100-day, and 50-day moving averages. And it starts on January 2nd, 2018, and runs through the end of this year. And as you can see, the market goes up, and then, there's that big drop in the middle, and that's the pandemic. And then the Fed reflated the market after the pandemic low. And I put an arrow to where Chairman Powell, in a single day, sold essentially all his stock market assets, which totaled about $5 million worth. If you'll notice what he did, you can take that down. But what he did is he waited till the market approximated its pre-pandemic high, and then he sold all his assets, knowing that he was, from that point forward, going to artificially move the value of the stock market upward in a channel at 30% a year. So he essentially, before he implemented that policy of keeping the market in the channel, inflating it at a rate of 30% a year, sold his assets so that he couldn't be accused of benefiting, from his own policy. And they're trying to turn that around and make it seem like he improperly sold stock. They're trying to scuttle his nomination. Whether that particular headline gets any traction or not, I don't know. Whether Chairman Powell is the best nominee, I really don't have an opinion on that either. But they need to either renominate him or nominate somebody else, and they're not doing it. And it's as that goes on, that becomes an increasing risk. On COVID, I'm just going to say, I talked about the data. The fourth wave peaked on on or about the week of September 4th. It's peaked. It's on its way down. It peaked at 2,050 deaths a day. It's below that now. So the fourth wave is essentially on the downside. Everybody in the market at the investment banks, most of the health agencies are publicly saying anyway that the fourth wave will be the final wave. So we'll see how that goes. On supply chain disruptions and inflation, I've been saying that those are going to be quantified by the corporate reports, earnings reports that we're beginning to see. We saw the banking sector last week. Generally good results in the banking sector. Forward operations are expected to benefit from the relaxing of certain regulations by the Fed. which is the main objection from Senator Elizabeth Warren to Powell's renomination. She thinks that he's relaxing those restrictions too soon. But there's other people that have other issues with him. But I read a schedule. Last week we had J.P. Morgan, Bank America, and United Health. J.P. Morgan, after its earnings, was down 2%. Bank America was up 4.6%, primarily on the relaxed regulation. And United Health was up 4.8%. United Health was up because on their conference call, they said that they anticipate that the fourth COVID wave that peaked on September 4th will be the last, and that they could move back to doing elective procedures, which are more profitable than what they have been doing, and so their stock went up 5%. This week, as I said, last week was kind of just the start of earnings season, all the financials. This week is where we really start, and then it gets much, much heavier next week. This week we have Tesla, Johnson & Johnson, Procter & Gamble, Netflix, Verizon, Abbott Laboratories, and Tesla. Johnson & Johnson, Procter & Gamble, and Netflix reported today, or are to report today. You can either report before the market opens, or you can report after it closes. Johnson & Johnson and Procter & Gamble reported before it opened this morning, and Netflix is going to go today after it closes. When you report pre-market, the reaction to your earnings report is in the day's trading. And Johnson & Johnson, as of this morning, their stock was up 3%, principally because they're talking up these vaccine boosters. How that makes any sense, I don't know. If the fourth wave is the last one and the last one is over with, and the vaccine that you created was for the alpha and beta variants, and the dominant variant that caused the fourth wave is Delta, which does not, which is distinct from the alpha and beta that you created the vaccine for. How that correlates to 3% enthusiasm, I don't know, but they must have come up with some rationale for it. Procter & Gamble reported this morning their stock was down 1.6% because they actually sell things. I had to talk about the supply chain disruptions and so on. Netflix, like I said, reports after. And then later this week, tomorrow, we have Tesla and Verizon and Abbott. And on Thursday, we have AT&T. And this is only from the top 30 stocks, which represent more than 50% of the market capitalization. But the point is, as these reports roll in, we'll see what people have to say about the supply chain and all that. Next week, Apple, Microsoft, Google, Berkshire Hathaway, Visa, MasterCard, Comcast, ExxonMobil, Coca-Cola, and Intel from the top 30. So next week is the heavy week for earnings. Bloomberg, the online news source Bloomberg reported that when Apple does their call, they're going to have to announce that the shipments of their iPhone 13 are going to be at least short by 10 million units because of chip shortages and problems essentially caused by flooding, typhoons in China. The White House tried to get involved in the supply chain shortages, and they trotted out President Biden, took no questions, spoke on the script, etc. He met with Walmart, UPS, FedEx, and the Port of Los Angeles. He said that he in his press conference, he said, we talked to the Port of Los Angeles, and they're going to go to 24/7 operations to try and use this supply shortage. The local paper down there, which is the Long Beach Post, called the operator of the port and said, you're going to go to 24-hour operations. And the guy at the port, spokesman for the port, I think, said, well, there's like 18 or 20 terminals at the port. There's 7 large ones that are capable of handling these over 100,000 ton cargo ships. and there's 7 of them. And Terminal T, which handles the over than 150,000 ton boats, Terminal T has already been on 24/7 operations on Mondays and Wednesdays, but they're going to expand that to Monday, Tuesday, Wednesday, and Thursday on Terminal T only. And Terminal T is one of the 7 terminals that can handle the large ships, and that's their contribution to moving to 24/7 operations. It's hard to know whether the president was just trying to make a talking point or he actually believes he made, some difference. The realities of the situation when you talk to anybody who's skilled in shipping and distribution is these supply shortages are going to last into the second half of 2022. The reason is fairly simple. 165,000 ton, which is enormous. I mean, that's just a huge boat or ship. But 165,000 ton ship carries at least 20,000 cargo containers. And even if the port can accommodate the ship and offload the containers, what do you do with them? All right, to move them out of LA to their destination, you need an additional 20,000 trucks a day. They don't have essentially very good rail out of the port of Long Beach. So it's mostly truck traffic, and that's the bottleneck. And that's why he talked to Walmart and UPS and FedEx, and they told him they're doing 24/7, but they have been, for the last couple of months. And the problem is evacuating the shipping containers from the Port of Long Beach. People that know what they're discussing indicate that these shortages are going to last until the second half of 2022. So it's interesting. Also on the political front, I love this, by the way. Senator Bill Cassidy, Republican from Louisiana, 64 years old, he proposed that we should be doing senility tests for Supreme Court justices and lawmakers over a certain age. I don't think, it's a nice thought. It's a start that somebody actually mentioned it. It's a nice thought. I just looked at the roster, Dianne Feinstein, 88, Chuck Grassley, 88, Richard Shelby, 87, Jim Inhofe, 87, Patrick Leahy, 81, Bernie Sanders, 80. Probably vote against it, even though Sanders could probably pass a senility test. Patrick Leahy could not. Jim Inhofe could not. Richard Shelby could not. Chuck Grassley, maybe. Dianne Feinstein could not anymore. Her mind went rather quickly. So that takes us to inflation. If you could put up graph number 2. On the inflation, we had the hard measures last week, the producer price index and the consumer price index. As is our habit, I just took certain categories that correspond in between the two reports and showed what they say. The Producer Price Index, or PPI, was released on October 14th, and the CPI, or Consumer Price Index, was released on the 13th. And cereal and bakery products are even, 1.1% each. Beef and veal went up 8.6% for producers and 4.8% for consumers. The number in red there for pork, 1.4, is a decrease of 1.4% for producers, increase of 1.7 for consumers. And on down the list, chicken was flat for consumers, 4.1% for producers, so on. The only big disparity in September was eggs. If you'll remember from August, we had a number of things where producer prices were going up over 10, sometimes over 20%. The only such major thing in this report was eggs. Up 20, the price of eggs up over chicken eggs, obviously, up over 20% for producers. So that means that next month the CPI for eggs or consumer price index for eggs is going to be 3% or 4%. And the only thing I would mention about all these numbers is that they're for a month, 1 month. Look at pipe natural gas. Everybody agrees it's about 2.5% a month. That's over 20%. That's over 25% a year, right? You can take the graph down. Alcoholic beverages fell 0.5% for producers, so I'm looking forward to that as the price diminution makes its way down to us lowly consumers. When they did the CPI, consumer price index, and the COLA for the year ended September 30th, it was 5.6%, I think, which is the largest increase in government payments, cost of living allowance, COLA, since 1981, I think, 40 years. Next year is going to be terrible as well. I mean, pipe natural gas, gasoline, food products, inflation's out of hand. No shortages, but much higher prices. It's going to have to affect economic activity and producers and corporations, but we'll see. If you could put up graph number 3, please, Justin. So this is just where we are as we go into earnings season here. This is just another graph of the S&P 500 with the 50, 100, and 200-day moving averages with a couple of call-outs. The all-time market high reached on September 2nd, and then the low, which was Monday, October 4th, 5.2% off the all-time high. The support level is about 4% off the all-time high. And as of yesterday, we were only 1.1% off of the all-time high. Yesterday, as we head into the earnings reports. So it's a good place to start. There's room to move down without significantly hurting anyone. If you can take that one down. And we're going to wait some more, man. See what happens with all these corporate reports and how many of them have to say that their revenues are going to be down because they don't have goods to sell and the prices of the things that they do have to sell are going to be up. And like I say, that, starts to get heavy this week, gets really, really heavy next week. If we move to our portfolios for last week, just to see how they did. Last week, the market was up 1.8% overall, which is a strong move. On one of our $100,000 portfolios, you should have returned $1,800. We have 4 of them. 2 of them are just the top 30 stocks, which represent more than 50% of the market value of the S&P 500. One's cap-weighted, one's equal-weighted. The cap-weighted went up $1,953 instead of $1,800. And the equal-weighted went up $1,650 as compared to $1,800, so both pretty close. When you only take the top 30 stocks, you don't have any companies in materials or materials, real estate, utilities, and only one energy company. So to correct for that, we created another portfolio called Top 3 Every Sector, where you just take all 11 sectors of the S&P, include the top 3 stocks. And that one went up over $2,000, $2,030 instead of $1,800. And then my portfolio, which only has 13 stocks in it compared to these 30, went up $1,300 on 13 stocks. But I'm completely hedged, so I had to subtract 1,100 of that, so I'm up $200 net for last week on a 1.82% increase. For the last 3 weeks, we've been saying that the largest stocks didn't participate in these downside moves and these upside moves that we've had for the last 3 weeks. Your largest stocks that I'm talking about: Apple, Microsoft, Google, Amazon, Facebook, Tesla, Berkshire Hathaway, Visa, etc. They did. They started to participate again this week. Microsoft, was up 3.19%. Amazon was up 3.7%. Tesla was up over 7%, 7.3%. Apple was up 1.4%. And then Nvidia, which was up 5%. Google was up 1.1%, and so on. So in this week, this 1.82% move had good participation from the largest stocks, unlike the last 3 weeks. If we look at all 54 stocks in all the portfolios, 8 of them, well, first off, 54 stocks in all 4 portfolios, 40 went up, 14 went down. 8 of them went up more than 5% last week. We had UPS on increased shipping volume, obviously, 5.6%. Kinder Morgan, which is a pipeline company in the energy sector, but they don't produce, they're a pipeline company, up 5.7%. Adobe, up 5.8%. Lowe's Company, up 6.3%. Don't know why. Prologis, which is a real estate investment trust, 6.6%. Don't know why. Tesla, on good sales, 7.3%. Target, 7.3%. Target and to some extent Home Depot. Oh, and let me finish the list. APD, which is Air Products, an industrial concern that I got called out of, one of my favorite stocks, went up 10.3% last week. I would repurchase that if the price ever dropped. But they're a well-run company in a good field. They have a product that all industrial people need. So, but Target, in response to the supply chain shortage, and to some extent Home Depot, but particularly Target and Costco, did something smart. They went to their producers, principally in China, prioritized which goods they were really short on, had no domestic production of, and prioritized those goods, put them on smaller ships, not 165,000 ton ships, 75,000 ton ships, 65,000 ton ships, smaller, and shipped them to the other ports, Port of Portland, Port of Seattle, San Diego. And so they're going to, they anticipate these big box stores, those two in particular, Costco and Target, are going to have more product than all their competitors through the upcoming season here, because they actually did something intelligent and increased the volume through the smaller ports. Behind those guys, you had 11 stocks that went up more than 3%, but less than 5%. The notable one in there is Nvidia, which rose 4.95%, so almost 5%, but not quite. And then, Amazon was up 3.7, Nike was up 3.6, Microsoft was up 3.2, PayPal was up 3.2, Philip Morris, I just like, good stock, up 3.2. And then you had 11 stocks that were up more than 1%, but less than 3%. Apple in that group, Google in that group, Chevron in that group. And then you had 10 stocks that went up, but less than 1%. ExxonMobil, Walmart, Visa, MasterCard, Costco were all in that group. 7 stocks that went down, but down less than 1%. In that group, we had Netflix and Abbott Labs and ConocoPhillips. 3 stocks that went down more than 1%, but less than 2%, Comcast, Facebook, and Verizon. And 4 stocks that went down more than 2%, JP Morgan on their financial reports, as we've already discussed. Pfizer, 2.26%. I sold those Pfizer puts at $50.50 a share. Pfizer closed last week at 42 to 42.45. And this morning, I think they're 41.37 or something, but they're going away. Their vaccine is, as we get more and more information, it looks less and less attractive. Let's put it that way. AT&T was down 4%. Boeing Aircraft still cannot get a plane in the air, down 4.13%. And that's the list from our 50. I just find it shocking that our politicians and the regulators and the department heads, which were all political employees that they appoint, have absolutely no conception of what it is they're managing. They think it's a simple matter of going to the port and asking them to accept more ships. Even at the port level, even if that were true, which it's not, because the problem is evacuating the port through the metropolitan area of Los Angeles. That's the bottleneck. But even if that were true, you can't do that because they don't have, it's like a giant airport. The air traffic control person at an airport, his equivalent position at a harbor is called the harbor master. The people that load, the people that get the planes to the gates, their equivalents are all the tugs, right? To move the ships around. And then the people the baggage handlers at an airport, their equivalent would be, the dock workers and the crane capacity. And you can't just snap your fingers, and increase that capacity. And they don't seem to have any cognition. That's the case. If they were good managers, what they would, the thing to do, and it's very difficult, but, condemn some of the land around Edwards Air Force Base, create high capacity rail lines out of the Port of Los Angeles going to this part of Edwards Air Force Base, and create a distribution center there, and then build road spurs into Highway 5, Highway 15, and Highway 10. Right. And, it would be a long-term solution so that you had some ability to moderate flow, in and out of the Port of Los Angeles. Take 10 years minimum, probably be in court for the first 10 and then another 10 to build. And we certainly didn't do that 20 years ago. So we're stuck. And they don't seem to realize that. And despite their best efforts and all the rest of that, the damage from the past is already done. And they were the people that did it. They've been in office for 40 years, right? So these are the guys that did it. They're not going to admit their mistake. And we're going to be stuck with this until the end of next year. Hasn't reflected in stock prices. So I'm going to wait some more. Stay hedged. And that's it for today. It's Tuesday. It's always Tuesday. This has been the Bogdanich Perspective. Thank you for joining. If you have anything you want to address, send me an email. Paul@stockbetter, BETTOR.com. Paul@stockbetter.com. And join me again next Tuesday. See what happens with the earnings reports and how many corporate executives are realistic on their conference call. And do Virginia. That means goodbye.